Welcome to the Broken Pie Chart Podcast, episode 184. I'm your host, Derek Moore, and with me is my co-host, kind of permanent these days, Jay Pestruccelli, CEO of Zega Financial. How you doing, Jay?
Doing great, Derek. Glad to be back. Is this 3 weeks in a row, 4 weeks in a row for me? It's something.
I think it's three. But next week is an even number. You know, it's 185 next week. This is 184. So I'll expect you'll miss next week.
Sure, I'll bag you next week.
All right. So we've been getting a lot of questions about one of the core things we do is sort of hedging. And we have what kind of a flagship strategy, buy and hedge strategy. And you and I have been talking a lot. We've been getting some questions lately. And we said, you know what, why don't we just turn on the mic and record a normal conversation that you and I would have as we talk about things like why we hedge, how it works, what is protecting, how it helps investors stay invested, how it helps investors reduce some fear, get rid of the timing. And so I jotted down a few things, but really this will just be kind of a free-flowing conversation. So let's just start here. I mean, we say hedging, by the way, I know most people in the audience probably are like, oh yeah, I know what hedging is, but maybe define what hedging is in our terms and why do we hedge, Jay?
Yeah. So hedging is not, what you're doing outside your bushes this 3-day weekend, although by the time people hear this, they will have already done their long weekend, which I can't say I'm not looking forward to. Could definitely use a 3-day weekend after the last, what do we think, 2 weeks in the market have been a little choppy for us, Derek. No, hedging, just a bit. Hedging for us is a way of what I'd like to say, providing some sort of an offset against your main market thesis. And the way we invest in this strategy is, we are believers that markets tend to go up over time. You look at the last 100 years, and I think the number is 70% of the time the market is up, right? A small percentage of the time it's flat, and then 20% of the time it's down. So it's one of those things that we like to utilize the broad market as a way of investing over the long term for people, right? It's not a 1 month, 1 year, or even a 2 year, 3 year period. It's longer term investing. And so we'd like to use those trends. But not everybody has the time or the risk appetite to just be long the market. And so we like to talk about hedging as a way of being invested, take advantage of those long-term trends that exist in the market, but in a way that, is going to limit your risk when you have years when the stock market has some chop. Right. And so that's the way I like to put it. Right. When we say we're hedging, that's the way we look at it. Long equities with some sort of risk mitigation in place.
Jay, I know that one of the benefits in my mind is thinking about eliminating the need for investors to time things perfectly. And I know right now we seem to be in a very reactionary period where a little bit of news comes out and it's okay, things are bullish. A little bit of other news comes out. Oh, it's bearish because now the Fed's going to raise a lot more. I'm just kind of thinking, and I always bring this point up, there are different periods of time where markets have been going up and people are calling for market crashes. Other people are calling for other things. And I think it's important for investors to sort of sift away the sensational sort of news. And I always bring this up, Jay, because if you do a Google search, and you can do this, you can go in and put in a certain year. So put in 2013, 2015, 2017, and you put in the search term, markets will crash soon. A lot of times the same people who have been saying recently that the market's going to crash have been saying it every year, and they keep saying it. And so I think one of the benefits, Jay, in getting back to why hedge is it's really difficult for people to try and say, is now the time to get in, or the market's down, is now the time to buy, or the market's high, should I? And I always go back, Jay, to after 2008, 2009, people stayed in cash for a long time. So I think one of the benefits is just, if you could talk about it too, the idea of what does being hedged do for you? I know I've just been hammering the time elimination thing, but I think there's a lot there.
Yeah, there is. And so I would say you touched on a few things. Actually, by the way, I would agree. The market will crash. I don't know when. It may not be for 20 years from now, right? Or maybe it's happening now and we don't see one of these for a long time. Sure, it's like the easiest thing to throw out there to grab headlines. But I just told you a minute ago, markets go up on average 70% of the time. And by the way, I don't think people recognize this. Half the time, if you look at each individual year, half of the time, I mean, one every 2 years, the market's up by more than 15% in any given calendar year. It's like kind of a ridiculous number when you hear about it. If someone told you, hey, half the time you're going to make 15% or more, and then the rest of the time you're going to kind of flounder around between, flat, down a little bit, or maybe and every once in a while down, dramatically. It's almost like why would I not want to be invested more over the long term? And that's why timing is such a fool's game, in my opinion. Because if you just stayed in the market, if time wasn't an issue and you could just stay in the market, markets have historically always gone back and rebounded past previous highs. I guess it's fair to say, we don't know what will happen after this sell-off that we're in right now. But, the beginning of this year, the market closed at an all-time high. And so every rebound in the past, however long the stock market's been in existence has absolutely been rebounded when it comes to the U.S. stock market by measured with the S&P 500. And now that's a pretty important distinction because there are other methodologies to invest where you might not get back to an all-time high. Like favorite topic of yours, Derek, a little tongue-in-cheek here, is crypto. I don't know if Bitcoin's ever going to get back to 68,000. It may never. But what I do feel better about saying is when the S&P 500 hit 4,800 at the end of last year, history tells me we'll get back there at some point, right? If you have the time. So, trying to time when to get in and out is almost unnecessary if your time horizon is long. But not everybody has a long time horizon, right? Not everybody has 10 years to offset a lost decade like what happened between 2000 and 2010. That decline actually took 10 years to rebound from, but it did eventually. And any dollar that you invested from, when the crash started in 2000 up until 2010 made money, right? Because you just added because over time markets rebound. So why even bother trying to time the market? To us, we think it's silly because you want to be invested for the long term. But that doesn't mean markets should be unmanaged, right? And so if you're approaching retirement, right? If you have like 5 years until you're going to start taking money out of your portfolios, you need something that will help you deal with market declines, right? If in all honesty, I usually don't recommend the buy and hedge strategy to be a large allocation for someone in their 30s and 40s, right? I just don't. But it is more appropriate for that investor that is approaching and in retirement, and especially if they're taking money out of their portfolio. So with buy and hedge, I know I'm going on a long time on this. The whole point of this strategy is so you don't have to time the markets. Timing the markets are tough. We did a study, Derek, and you helped with this quite a bit, which was if you missed just the best 2 days of the year through market timing, right? You might have, hey, market dropped, market bounced, and I just happened to be out of the market the day that the best 2 days of the year occurred. Over time, over the last 20 years, you would have turned positive gains that were like 180% return to a negative 35% return just by missing the best 2 days out of the year. And it's really important for us to make people realize that, by the way, I don't know when the best days are going to be, right? But you have to be in the market. It's about time in the market, not timing the market. And so, you don't want to have to endure the big downdrafts like what we have right now. So you got to hedge. You got to manage your risk when time is not your friend. So I just unpacked a lot there, Derek. Anything you want to kind of expand on when it comes to, the benefit here with this strategy is that it is managed and you don't have to time the market.
Yeah, I mean, I think, and of course, past performance is not indicative of future performance. We don't know what's going to happen in the future. There, I kept the my disclaimers in there. One of the things I think I'll bring up too, and you talked about who it's right for. I would say that if somebody, even if they're in their 40s, 30s, If the alternative is staying out of the market because they have so much fear, I think buy and hedge, a hedged equity strategy, is completely appropriate because the ability to stay in markets. The other thing I'll bring up, and maybe we can touch on this a little bit, is there's really three phases for investors. There's the accumulation, the distribution phase. Accumulation is, you're getting all of these, you're putting money in over time, you're dollar cost averaging, maybe it's a 401k. And by the way, if somebody's brand new to investing and they're just putting money into, they don't need us. They don't need us. Just keep doing what you're doing. The distribution phase, of course, is you're drawing income. You're in retirement. You need to draw those assets down. But there's a phase that's never really talked about. And it's I call it the base maximization phase. And that's that 10 years before retirement, because that's that last kick that someone needs to really ramp up their assets in their peak earning years and the ability to get growth. As you and I have talked about before, and we talk about this all the time, people tend to need more growth than they think. So framing it in those types of phases, I think for the near retirement and in retirement, Jay, wouldn't you say one of the benefits is the ability to reach for more growth while also taking out some of those potentially really big declines, right?
Oh yeah, yeah. I mean, one of the main, as I started right when I was describing the strategy a little bit, is you want to capture some of the growth of that market, and those are the years where you have the most money. You've accumulated the most money. I like the that small window that you're describing in an investor's life cycle, where you've got, you have the opportunity for your money to work harder than you can, right? You couldn't normally, people in their 50s aren't able to put away as much as their portfolio can generate on its own. So your portfolio is working for you there. You want to take advantage of the broader trends that markets tend to go up over time. But you're right, right? It's if you have any growth needs, right? If you can't live off of 3% a year, right? So you have growth needs, then yes, this is exactly why you use this, right? You have a growth need, but time is your concern. Absolutely, that's to me, the most appropriate time to use this strategy. You did touch on a piece that I thought was really interesting that we discuss from time to time, is for that person that's in cash. And I would agree this absolutely is a better alternative for someone that is, sitting on the sidelines in cash, especially with inflation in the 8 to 9% range, where you need some sort of growth to offset just, inflation in general. So my guess is, if you're that person and you're sitting on the sidelines and you haven't bought the market yet, it means you're a little more risk averse, meaning you don't want to take more risk than the average investor. So this is a way to invest with having protection in while the market is at a discount, right? So I think you ended up hitting on a few really interesting points there on how the strategy could be appropriate for that, lower risk, but also younger age investor.
Jay, all my points are interesting and exceptional.
Of course, the most interesting. I didn't mean to insinuate they weren't. Right?
So when we think about buy and hedge, our flagship strategy, and the way we hedge, there's some benefits. There's also some trade-offs, and I want to focus first, and maybe I'll save. I want to get to the idea of reinvesting avoided losses, and there's this hedger's opportunity. Let me save that for now. But if you can kind of go through, let's talk through the benefits of hedging, and then maybe we'll switch to the trade-offs that somebody gives up by using hedged equity as opposed to just being invested in the market. So benefits first, Jay.
Yeah, like all things, there's benefits and trade-offs when it comes to the markets, right? There's no, hey, there's a win-win situation here. Normally that doesn't exist. There's always a give up. So we talked a little bit about the benefit of timing, the benefit of capturing the upside growth of the market, the fact that we're using the S&P 500, which historically has been that index that has recovered all losses, right? So those are a lot of the things that we talk about, and we haven't even got to the how the active management goes. But I will say there are some trade-offs for all of that, because this sounds pretty good, right? The first one is there's a cost. There's a cost of being hedged. There's a cost of having the protection. And I like to say we're all hedgers when we live in America anyway. And what do I mean by that is we're all forced to buy insurance, whether it's car insurance or homeowners insurance or health insurance. Yeah, I mean, we're actually forced to buy those things when we live in this country, right? Or we're penalized if we don't. But the concepts of insurance apply here, right? You have the asset you're protecting. Let's say it's your car. You're protecting your car. In this case, with us, it's your portfolio. You have a time frame that you're protecting it for. Usually insurance policies are a year, 6 months. For us, we're hedging out a year or 2 years at a time. So that's our time frame. You have a deductible, right? The amount of money that you could, the amount of damage your car would take before your insurance kicks in, right? If you have a deductible of $1,000 and you have a fender bender for $500, you don't use the insurance. You just pay the $500 to fix the fender. And then the fourth piece is the premium. You pay a premium to buy that insurance. And the piece that I want to talk about right here is that there is a cost, right? There's a premium associated with being hedged in the market. For us, that typically runs at a 2 to 4% annual cost. And that shows itself in an underperformance against the market. And so while I said that we like to be invested in the market and the market's up, fairly consistently, we will drag against the market in those years. And that is the cost of being hedged. Typically, we're only going to capture 65, 70, 75, maybe 80% of the market on those up years. The more it's up, the greater the percentage we capture. But that cost of hedging is really reflected in the underperformance on the upside appreciation. Now, in a down year or a flat year, it's not like you didn't pay your insurance. You still pay for it, so it's in there. It can become more evident on the cost of hedging. So if the market was flat one year and we had a 4% cost of hedging, we would deliver a minus 4%. So that's the give up, right? On some of those flat years, it's not going to look as attractive to have been hedged. In the up years, we're going to lag a little bit, but we still are going to capture that all of those years that have those gains that we talked about, right? 70% of the time, the S&P is up. We're going to capture those at the same, not magnitude, but the same rate of growth in those years. So to me, that's probably the biggest trade-off that I'd like to say when it comes to hedging.
Yeah, I think, and to remind the audience, when we say what we give up, it's not a fee. It's not, there's a 4% cost or 2% cost. That's the residual cost of hedging. So there is you don't sort of get eat your cake and make your cake and what is the thing? Get your cake and eat it too. Put the eggs in the basket.
we don't have to tell anybody what it really is, apparently, except you, right? So let's just move on. Everybody knows what it is. You got some cake and you're not sure if you're eating it or you have it. We don't know.
I can't remember that. All right. So anyway, it's what you give up. It's what you don't get all of the upside in a hedged equity strategy. Normally, there are cases that you get more, but we'll get to that. And then just thinking about the design of the strategy itself, what are there's a limit, or the goal is to limit losses on the equity positions to a certain percentage over a 12-month period. So let's get into that.
Yeah, let's get to the nitty gritty. Like, all right, what are you really hedging against? And that's right. So in a 12-month period, the strategy is designed to not lose more than 8 to 10% in our equity exposure, right? So your stock portion of the portfolio is designed to not lose more than 8 to 10%. And this year is a great example of that, where, the first half of the year, what was the equity market down? 20%?
24-ish, yeah, something like that.
I think at the bottom it was at 24. Well, our buy and hedge portfolios, when you look back over a year, lost, the equity portion, meaning the stock portion of those portfolios, lost around 9%. Some might have been 10, might have been 8, right? But just depending on the days of your entry, the equity portion of the portfolios was limited to 8 to 10%. That's our goal, right? And the way we do that is we only invest 8 to 10% at a time in the stock market, right? We use options to create that exposure. So when we'll buy a call on the market, right? Call gives you the right to buy the S&P at a certain price at a certain time. And while the details of the options aren't important to me, what's important is as the market goes up, that call reflects the market's appreciation generally. As the market goes down, that call will lose money, but it can only lose what you paid for it. So when we only spend 8 to 10% of our portfolio on the exposure to the market, then I'm limiting my risk, because if the market was to drop more than 8 to 10%, I can only lose what I paid for that long call. And that's the general concept of the way we hedge in the buy and hedge retirement strategy. We limit our risk by only spending 8 to 10% on that equity portion.
So the market goes down 50%. The equity positions, in theory, right, only go down 10%. And the reason why that is, you can only lose what you paid for the long exposure, the long calls. So that is a benefit. You mentioned one of the trade-offs was the idea of, okay, there is a little bit of a cost to hedging because we are buying calls. And if all we did was buy calls and nothing else, that would sort of be expensive. So the other side of this is the fixed income side. And so, Jay, I'll take this one, and you can chime into it.
Well, I'll chime in first before you chime in on the fixed
Do
income,
it.
right?
Yeah.
Only because, yeah. So because you're right, the question is, okay, Jay, you only spend 8 to 10% on your equity side. What'd you do with the other 90%, right? And you're right. If we only bought the calls and did nothing else, it would be expensive, right? The cost of hedging could potentially be 8 to 10%, right? Which means you'd need a break even of 10% before you start making anything, right? And so, but we've got 90% of the portfolio unused, right? So the idea here is to invest it in a way that generates some yield. We're going to talk about fixed income in a moment, but it doesn't necessarily have to be fixed income. The idea is invest in a way that you can earn half of the cost of those calls, right? How do we make 4% back with that 90% that was unused, right? And so I like to reference that as the yielding portion of the portfolio. It's just designed to give us the safest yield we could find that's commensurate with about half the cost of the calls. In this case, let's say we're looking for about 4%. Okay, so now, Derek, I'll rotate it back to you, because we have used in the past, the most recent past, some version of a fixed income portfolio, and I won't ruin the surprise yet. So I'll let it go to you, and maybe you could talk a little bit now about how the yield portion is constructed and what the dynamics of that piece are.
Yeah, and this may vary a little bit. There's some slight different variations of the buy and hedge strategy, but in general, yeah, I mean, we use very short duration corporate bonds, and typically of over the last, I don't know, 10 years or so, we have used short duration high yield corporate bonds. And why short duration? Well, fixed income, there's two main risks in fixed income. One is defaults. Company issues a bond, you buy the bond, it's paying interest, and they default, meaning they can't pay the interest or they can't pay back the principal, or both. And that's one of the main risks. I will tell you, over the last year, the default rate in high yield, all high yield, not just on the shorter end of the spectrum, has been just a little bit over 1%. It's been very, very low. But the interest rate risk that fixed income bond investors have is that if they hold a bond and interest rates go up, bond prices go down. The inverse happens. If interest rates go down, theoretically, bond prices go up. And so the risk of higher rates is much greater the higher or the longer time a bond has till maturity. Now, I won't get into the real nitty gritty of it, but it's the lower the amount of interest that a bond pays and the longer time to maturity it has, the more interest rate risk it has. So by us using these corporate bonds that are short duration, already we have a more limited negative impact from a rise in interest rates. And that's one of the reasons why this year, if you look across the spectrum, things like 30-year treasuries, 10-year treasuries, U.S. investment grade corporate bonds, those, if you look at the low points during the year, they all perform worse than short duration high yield. And the reason why that is because the bonds that we use pay more interest, they are shorter duration, and on a total return basis, they took less of a hit. So that's kind of and then as you said, Jay, we take the interest, we take dividends if we're using, exchange traded funds or we're using individual bonds, we take the interest, and that helps to defray the cost of hedging, as you put it. And so now, if the market's flat, if the market's completely flat on the equity side, the amount that an investor will give up is less. So let me kind of stop there, Jay, and see if you wanted to add anything on this portion of the portfolio, and then I think we can also talk about sort of the opportunity going forward. But let me kick it back to you for a sec.
The only other piece about the yielding portion today that I bring up is because we invest for longer periods of time, that yielding portion is, while it's regularly reviewed, we put it on with the expectation that that position is going to be um, on for a little bit so we can earn the yield we're trying to get. And so the question I get sometimes is, Jay, what treasuries, a 2-year treasury right now, because I think you just mentioned our duration is on the lower end. It's just over 2 years, I think, right now in our portfolio, which is definitely on the shorter end of things, which is good. Why not just buy a 2-year treasury, Jay? It's paying 3.5, 3.4% this week. Why wouldn't you do that and then take away, the risk of things like default, right? Or even the equity correlation that high yield may have.
Yeah, and I think there's two different ways to look at it. One is for existing portfolios, and one is as we go forward, what types of pieces might we bring into the portfolio? Well, at the beginning of 2022, interest rates, let's say on a 2-year treasury, were not 3.5%. They were much lower. They were a little bit north of 1%. And although the duration is very low, so 2 years, and the duration calculation, we'll leave that for another time, it's not how long you have until maturity. It's a combination of the coupon rate and the time to maturity. And the calculation is a little bit more involved, but your duration is usually so let's say a 1.7 duration means for every 100 basis point, every full 1% rise in rates, you would expect your underlying bond to lose about 1.7%. Okay. So, yeah, I think going forward, if treasury yields are higher, they may have a place in the portfolio. But our existing portfolios, where market values have gone down because interest rates have gone up, we are still collecting interest and or dividends from those fixed income assets, the bonds. But bonds, when they go to maturity, they mature at par value. Barring defaults means $100 or $1,000 per bond. I think some of the bonds, if you kind of look at our existing portfolio, they are trading a lot of them at 93 on a weighted basis, something like 93 cents on the dollar, 92 cents on the dollar, meaning there is more appreciation possible, not certain, but possible, as those bonds move further along in time. And so not only the coupons, which are higher, the interest payments that are higher than treasuries, but also the potential appreciation. And so I think that's one of the reasons, Jay, when you and I get asked the question, hey, why not rotate out of some of this? I think we look at this on a total return basis, meaning the change in potential market value and the amount of dividends / interest we will get in. So I think that's the main point. Jay, I don't know if you had anything else to add on that.
No, that was the point, right? Like, hey, you couldn't use treasuries a year ago, right? Yields were way too low. Wouldn't have made the money that we would have made, and by the way, we wouldn't have avoided much of the risk that we ended up experiencing. And then you're right that going forward, yeah, new builds today make a ton of sense to have a bigger treasury component, right? We like rates here. I mean, of course we like it, right? The 2-year hasn't been at this high of a yield in the last 15 years. That was all over the news this week. If you were watching any financial station, right, where they say, well, the 2 years hit a 15-year high in yield. Like, yeah, we like it. It's a good time to buy, a 2-year treasury, right? So yeah, we definitely use those when we have new builds, but existing builds have kind of this inherent discount built into it. And as long as there aren't defaults, which you just mentioned earlier that they're low, those bonds should appreciate towards par, right? So you got appreciation and you got the dividend. It makes a lot of sense to continue to hold the existing positions. So no, I just reiterated what you just said.
I will say also that a lot of times we look at buy and hedge, our strategy, and we say, well, what's a good comparable thing to look at? And I always take a look at the 60/40 portfolio. And this is a great example of a year where, due to interest rates rising and the fact that rates were so low, the 60 meaning 60% in stocks and the 40 meaning 40% in bonds, that 40%, I think at one point was down the same or more than the market. I think I haven't looked recently, Jay, but 60/40 has not protected investors this year. And I think that's an important point to bring up, Jay.
Yeah, well, that's really it. Like the modern portfolio theory would tell the long-term investor to use a 60/40 breakdown. I like that they call it modern portfolio theory. I think at this point it's over 70 years old, right? It was developed in the
Yes.
50s. Am I correct? Right. So to me, not so modern. So I think this is a more progressive and sophisticated means of meeting the needs of that 60/40 investor, right? And that's really the target market here for us. And it's really who it's appropriate for. So, when we talk to people that have had a 60/40 build, they're all very disappointed this year, right? Because that 40 didn't give them the offset, right? Everybody always thinks, oh, stocks down, bonds up. Nope, not this year. This year was stocks down, bonds down, right? Actually, everything was down this year. So there weren't a lot of places to hide this year, but this is a very unique year when it comes to investing. But again, we look at broader trends versus the 1 year, certainly the first 8 months of this year. But that's right, Derek. I think it's important to say who it's. This is kind of what I would call it comparable to, is that modern portfolio theory 60/40 build.
Isn't like the Museum of Modern Art? Don't they have stuff that's much older than current too? I haven't been to the one.
The MoMA,
I haven't been
don't
to the
know.
one in New York in a while, but
Yeah, it's been a while. Yeah, for me too.
all right. So let me get to this too. I think one of the benefits is that we haven't touched on, but I briefly mentioned it. It's the hedgers opportunity, and there is one of the cases, a strong case for hedging in my mind is, first, staying invested in the market, limiting the losses on the equity side, to trying to set things up. No more than 8 to 10% is the goal over a 12-month period on the equity side. We talked about that. But it begs the question, if the markets go down tomorrow 60%, you wake up and the S&P is down 60%. If you only lost 8 to 10% on the equity side, Jay, I think this sets you up for the hedger's opportunity, right? What is it?
Well,
What does it mean? Yeah.
Yeah, of course. We started out talking about how markets eventually rebound, right? So why hedge, right? Okay, maybe you don't have a time limitation, but why even bother hedging, Jay, right? Sometimes I get that question. And the answer is, then why'd you buy insurance on your car, right? It's for the protection. When your car has an accident and you need to utilize your insurance, you don't go, that's all right. I'm just going to, let that go. You cash in on your insurance. Same thing with hedging. If you're hedging, you must cash in and take advantage of the fact that you are hedged. And for this portfolio, the way that we look at it is, once we've experienced, significant amount of that 8 to 10% risk that we take, we now know that we are avoiding some loss, right? So let's say the market's down 25% and I stop losing money at 10, I've just avoided 15% of the market downdraft. Well, I could now buy the market at a discount of 25%. For me, I'm using dollars that only took a 10% dip. So it actually allows you to reinvest in the market. We like to say reinvest avoided losses. You reinvest in the market while it is at a discount with dollars that didn't experience that loss, which is very different than when you're invested in the market, right? And you're just long the market. If you're just long the market and the market drops 25%, all your dollars now were discounted by 25% also, right? So what can you do? I mean, yeah, maybe you decide to rotate it out of some Apple and buy some Facebook, right? Maybe that's the kind of rotation you want to do on an individual stock because Facebook was down 50 while Apple was only down 10 or whatever it was. Yeah, okay, that's a choice, but you have to come up with money in your portfolio when you want to buy the broader market at a discount. For us, we don't. For us, we'll dip in to that 90% of the portfolio that was invested in what I'll call that yield portion. We'll dip into that piggy bank, right? It's there for us to utilize and add exposure to the market, right? So we end up putting money to work, buying the market at a discount, and we end up having more shares, more exposure on the way up than we had on the way down, right? So what happens is you end up creating this opportunity for outperformance on the way back up. Because if you weren't going to do anything with the fact that you were hedged and avoided a loss, then there's not a lot of point of doing it. And so Derek, I actually think I have to give you full credit for coining the phrase the hedger's opportunity years ago. I don't actually think that's even in the book, right, that I wrote in 2010, 2011. I think you actually ended up coining the phrase the hedger's opportunity in 2013, 14, because you said, look, Jay, there's a way to express this notion how you need to take advantage of your profit or your avoided loss and put that back to work so that when the market does eventually rebound, you end up having more exposure on the way up than you had on the way down. And it ends up helping you capitalize on the fact that you avoided the loss.
I think one of the things too to bring up is a lot of traditional strategies like the 60/40, like others, they do this rebalancing. And rebalancing means if stocks went up and bonds went down, you trim some stocks, you buy some bonds. The way we do it is a little bit differently in that in the buy and hedge strategy, we have tranches, which is a French word that suddenly became very popular 2008, 2009, when they had the tranches of mortgage bonds and things like that. But it really is just a fancy way for saying when we put on equity exposure, we're not always buying the call options at one maturity, meaning we don't necessarily always use like, oh, we're using the one that expire in a year from now or a year and a half. We ladder these out. And so, Jay, I think that's really the alternative to traditional rebalancing is as those maturities come up, that gives us an opportunity to sort of make reinvestments at lower levels or to take risk off by reducing the exposure to equity. So maybe that's something maybe you want to touch on just briefly.
Yeah, you flipped the script there a minute and inadvertently, not inadvertently, but you just hit on 2 points. So yes, so the first thing is, which when we talk about the hedger's opportunity, the fact that we deliberately spread out our expirations and our options, we're regularly given a chance to reinvest avoided losses, right? As one piece rolls off, it's not like the whole portfolio has to have this, all or none decision like what a rebalance does, right? When they, we've got to go from, we ended up being 70-30, we got to go back to 60-40, the whole thing gets rebalanced. For us, we're just adjusting those options, and we don't have to adjust them all at once, right? So we've spread that decision time out. Where you rotated to was on the upside, right? You rotated to the fact that while the markets are going up, the fact that we have this regular cadence of expirations means it gives us the opportunity to lock in those gains and re-hedge on a regular basis. So let's take the opposite of this year and take 2021, right, which was really the flip side of what's going on in 2022. In 2021 and 2020, as the market was going up, right, and our calls were appreciating in value, we would then say, look, this call that I put on that was 10% of the portfolio at the time has grown enough to the point that I don't want to have as much risk. I still want to be hedged. I want to lock in some of those gains. And so a market timer would make the decision of saying, oh, let me sell my profits and go to cash. With what we do, and which we think helps you stay more invested for longer, is we take the profits of that call, simultaneously close it out at a profit, put cash in our pocket, and then use some of the proceeds to buy the next call, right? And again, bringing my risk from 20 down to 10% again, right, by rolling that. And so let's say if I bought a call that was 10%, sold that call for 20%, I've just made 10% extra on that call. I take 10% of that gain, put it in my pocket. When I say put it in my pocket, it goes to the yield portion of the portfolio. And then that other 10% goes towards buying the next exposure, buying the next call. So it's really, when we talk about an actively managed portfolio, right, locking in gains and rolling hedges when there's profits, or taking advantage of declines and reinvesting avoided losses, whatever way you want to look at it, this portfolio, the buy and hedge portfolio, is managed for up and down markets. This is not a set it and forget it kind of a portfolio at all.
I think one question, a quick one I wanted to bring up too, is for anyone who's in the buy and hedge strategy and might say, well, the market was down, but the strategy lost money. And I think it's an important point. You already touched on, the 8 to 10% down. These portfolios are not hedged from dollar one, meaning if the market goes down until that sort of barrier, they'll go down. I think maybe just touch on that a little bit real quickly, Jay, because I think that's a question we get too.
Well, right. I mean, we just told you we're going to take 8 to 10% of risk in the equity market out of the gate, right? So while that is a limitation, it's still the amount of risk that we're going to take, right? We don't hedge from dollar one, just like you don't buy car insurance from dollar one, right? When I used that example, I told you there was a deductible, right? And I even gave you an example of when you ding a fender, you still paid your premium and you paid to get the fender fixed, right? So in that scenario, we do definitely take some risks. This is not a riskless strategy, right? We definitely have some risk in the portfolio. If you don't want to take more than 8 to 10% equity risk, then this is not the portfolio for you. But if you're invested in the stock market, you're taking much, much more risk than that anyway. But no, it's not from dollar one. We are willing to take up to 8 to 10% of risk in the equity portion of the portfolio. Yes, for sure.
All right. So we talked about a lot. I think the main thing is for people who are fearful, want to try and sleep a little bit better at night, still need growth in portfolio, still want access to equity markets, want to try and keep pace with inflation, have the ability, so if the market goes way, way down, have the ability to buy at lower levels. I mean, these are all things that potentially are very appealing on a hedged equity strategy. I will put a link in the show notes to the page where you can read, whether it's the performance or get more information on the strategy. ZegaFinancial.com, of course, is the website where you'll do that, but I'll put the specific link in there. You can also reach out to me, derek.moore@ZegaFinancial.com, with questions about the show or suggestions. I guess I'll say that. derek.moore@Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financials up to you to spell correctly.com. Jay, real quickly, I started watching Wrexham on Hulu. I don't know if you know about this show.
I absolutely do. I'm a big fan of those guys, right? I'm a big fan of It's Always Sunny in Philadelphia. So Rob, that's one of the writing members there, is a purchaser of the Wrexham football team in the UK. It's in Wales, right? Did I get that right? Boy, I probably just
Wales. I think.
Did I say Wales? Yeah. Wales. Yeah, I think it's great. I mean, Ryan Reynolds is right. Everybody loves him these days as well. But I've watched the first couple episodes of it as well, and I think it's it's good fun for the family, right? Like Lynn and Xander and I have watched that together so far, and it's been good, right? It's coming out weekly, right? The whole thing's not out yet, I believe, right? I've watched the first 2 or 3.
Yeah, 3 episodes are out, and for anyone who's not familiar with European football, that's soccer for us in the U.S. They have promotion relegation, and so imagine like in the NFL. The New York Giants had a bad season.
I can't imagine that possibly happening at all.
It's probably going to happen again. But they would get relegated to like a second-tier football NFL league, an American Football League, and they might keep getting relegated down. And so this Wrexham football club, soccer club, they are in like I think the 4th or 5th down league. But in theory, they could buy that club. And if they could keep winning promotion, it would take them, 4 or 5 years. They could wind up in the English Premier League, which is massive. I mean, that's the the Premier League, as they call it. So imagine like you have a little NFL, not an American Football League somewhere in the U.S. Like what is that? That League Two of arena football. Like if we had the same system, you could buy that team to eventually get to the NFL and probably supplant the New York Giants because they're going to stink this year, unfortunately, Jay.
But the Jets first. We'll all admit the Jets are going to go first.
They'll be relegated first, probably, because they're the Jets. It's just the way other teams get better.
It's two Giant fans, obviously.
Yeah.
So that's a good show. I definitely started watching that. I'm catching up also on Netflix, one called Sandman. It's a little more of a kind of a fantasy. Interesting. It's okay.
That's the comic book, right, Jay? Isn't that
there might have been comic book? I don't know if there one. And then the other one that I'm watching again with the family is the mildly entertaining She-Hulk on Marvel, right, on Disney Plus. So that one's not so bad either. Just fun. Don't have to think. It's good. We didn't really give any deep thinkers this week, did we, to watch?
No, I mean, I finished, Blackbird. That's still my strongest recommendation. Tough stuff.
I have finished it as well. Did I tell you I finished it?
No. What'd you think?
Yeah, good. I'm surprised it got your top, like your Succession and Billions rating, but it was good. But I probably wouldn't have given it the top.
Yeah. Succession, if you haven't watched that, just do yourself a favor, go watch that, and you'll thank us later. Send me emails. Send me thank you emails. All right, Jay. I think we beat this up enough. We'll leave it there. And thank you again for coming on. And next week we'll give or in 2 weeks maybe, our NFL predictions, which will be just as bad as our stock predictions at the end of
Perfect.
So.
Perfect, Eric.
All right, Jay. Thanks again. We'll see everyone next week. Bye.